Hi everyone, it's Alex King here at Sestrian Capital Research. Thanks for joining our weekly webinar. For those of you who are members of the Growth Investor Pro service, this is a regular event. And for those of you who come from our newsletter service or our Substacks, welcome. Today we have a very special guest, Justin Huhn, who runs the Uranium Insider Pro service. We subscribed to this service as a business about 18 months ago, and we found it to be superb publication that goes in huge depth in the exciting uranium sector. We ourselves in our own work overlay technical analysis on top of Justin's work, but the fundamentals upon which we rely come entirely from Uranium Insider Pro. So I'm delighted Justin's been able to join us today. He's going to talk a little bit about the sector and about his own work, and I hopefully you will find it fascinating as we do. There aren't many markets that you get to access in the early stages of financialization, but uranium is one, and that's why we're so excited about it. Before we start, we've got a regular disclaimer, which is on the screen right now, and for the benefit of the tape, I'm just going to read it out as well. So it's currently 5 p.m. Eastern, September the 22nd, and our disclaimer is as follows. Disclaimer, this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information or analysis in this webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in this webinar is intended to be investment advice, nor should it be relied upon to make investment decisions. Sestrian Capital Research, its employees, agents, or affiliates, including the author of this webinar or related persons, may have a position in any stocks, securities, or financial instruments referenced in this webinar. Any opinions, analyses, or probabilities expressed in this webinar are those of the author as of the webinar's data transmission and are subject to change without notice. Companies referenced in this webinar or their employees or affiliates may be customers of Sestrian Capital Research. Sestrian Capital Research values both its independence and transparency and does not believe that this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, so without further ado, I'm going to pass the screen over to Justin. Just bear with me one moment while we do that. Okay, Justin, all yours.
Thanks, Alex. I appreciate you having me on. Nice to,
most welcome.
Nice to speak with your audience. So I don't have much of a presentation here to share, but can everybody see my screen right now of the chart?
Not yet.
Okay. Not yet? Okay. Let's see. How about now?
Yeah, we got
it. So you know what, honestly, I probably should show the actual commodity itself, but even before going over this chart, I thought, could do a really 30,000 foot view of this investment thesis first, if that's okay, Alex.
Yeah, that'd be excellent.
Sure. I'm sure some of your listeners probably are familiar with the uranium investment thesis, at least, loosely. But essentially, this thesis came to me in late 2016, which happened to be the actual bottom for the commodity itself. So if let me go to a weekly chart on this, we can go back. 2016, the commodity bottomed out at $18, just above $18 a pound for the actual U3O8 mined uranium. Now there's a bunch of other elements to the fuel cycle, which I'll talk about a little bit more in depth as we go forward in this chat, but 2016 was when we bottomed out, just right around 18 bucks a pound, and we have since then risen up into the high 40s. We peaked out last autumn in the low 60s when SPUT really went kind of crazy. Excuse me, that was this spring, and pulled back a little bit here, but either way, we've been in an uptrend for the past 5.5 years, essentially, for the actual commodity. And so when the thesis really first came to me, the basic thesis essentially was this is a sector that absolutely everybody hates. It's been in a bear market for the past, let's say at that time, it was about 5 or 6 years since Fukushima. Nobody's interested, Wall Street's not interested, retail has completely given up, and the commodity is trading for about 1/3 of what it needs to trade at to bring on further production. We're sitting on, a growth sector that's projected to grow, 1 or 2% a year going out into the end of the decade or into the next decade at the time. And this is a super contrarian play. So that kind of piqued my interest at the time, and I'd primarily been a trend following trader, kind of a momentum trader up until that point with sort of dabbling in kind of fundamentals, but mostly just trading off of charts, really simple breakout patterns on volume that I like to trade. And that was essentially it. So this came to me and I was like, oh, this is kind of interesting. Very low stress. You know, the bet is eventually this commodity will turn around. This is a sector that's actually vitally important. It's 10% of the global energy mix. It's 20% in the United States, roughly. And the commodities trading for a third of what it needs to trade at to support the actual miners. And the reason that's possible has to do just with the supply glut that came from the previous decade. So, you know, I started to get into the thesis at the time, and I started to accumulate after studying it for about a year. You know, started to accumulate in 2017. And from there on, I just became more and more intrigued by this market, not only because my conceptions of nuclear itself were just so wrong and so misinformed, and that, you know, I always love to kind of get slapped in the face with my own theses about anything, and to realize that I'm wrong about something. I don't know why. I've always just kind of enjoyed that. It's like, oh, this thing that I've assumed forever is actually wrong, and that kind of intrigued me. And nuclear is actually the safest form of electricity generation that's ever been conceived. There's never been a problem with nuclear waste. There's never been an accident with nuclear waste. There's 450 something reactors currently running. It's a growth sector, et cetera, et cetera. It's clean energy. You know, this seems obvious if you spend 2 minutes looking into nuclear, but most people actually think it's dirty. It's absolutely not. So we can thank The Simpsons for that one. But, you know, just I became kind of an emphatic supporter of nuclear energy through this process, and the investment thesis has only gotten better since then, and it just continues to get better and better and better and better over the years as the equities have moved up and down. And so now you can see we're in this very clear uptrend, actually quite the beautiful chart for the commodity itself, in my opinion, with just these higher highs, higher lows, and it tends to go on these steep runs, then pull back a little bit, and then kind of flatten out for a moment and go on another steep run. And I think we're poised for the next steep run within the next few months, having to do with a number of factors. But the chart that I brought up first, well, let me just kind of bring it all together. The sector still continues to grow, and the growth rate is actually increasing beyond that 1 to 2%. Now we're looking 2 to 3%. China is building 6 to 8 reactors per year. They're potentially looking at up to 10 reactors per year. They're shooting for 200 gigawatts. They're right now at 50 gigawatts. They want to get to 200 gigawatts by 2035. But there's a dozen other countries that are also building nuclear in addition to China. China is obviously the biggest part of the growth story, but we have this whole new realm of nuclear, which is advanced nuclear and quote unquote SMRs, or small modular reactors, that are being embraced in multiple countries around the world, with a lot of money, a lot of excitement going into the engineering and development and the R&D and these various designs for small modular reactors. And that's very, very exciting. In fact, the Department of Energy in the United States just put out a report a couple of weeks back, essentially stating that about 2/3 of the existing and retired coal plants in the United States are in locations and have the types of grids that can support replacement of that electricity from coal with SMRs. So that's actually the federal government in the United States promoting the use of SMRs to replace coal. That's super exciting. And there's so many more developments like that around SMRs. I could go on, but I won't. And lastly, in 2016, 2017, I never would have dreamt that nuclear would be embraced as the potential savior for the quote unquote climate crisis and energy crises in general, and to actually have a certain element of the, let's say, the environmental left embracing nuclear. And that's happening right now. And so we're kind of undergoing sort of a nuclear renaissance, while at the same time the original fundamentals that were based essentially on the supply and the demand numbers for the sector are completely intact. So now bring us fast forward to 2022. We've got, let's say, about 175 million pounds of uranium demand this year by the reactors alone. So just the burn rate of the 450-ish reactors that are currently operating in the world, they're going to consume about 175 million pounds of uranium this year. There's going to be about 130 to 135 million pounds of mined uranium this year. So structurally speaking, we've got a 40 million pound deficit. Now we do have, and that's just this year, right? That's a snapshot of this year. There is some secondary supply, but there's also secondary demand. So the Sprott Physical Uranium Trust, for example, has purchased 17 million pounds this year already. So now you add that up, we're looking at 190. If you add Yellowcake, another physical fund, it's just a massive, massive deficit. And so all of that is to say that the setup has only improved. And while the equities are certainly off the very bottom, they have not run, in my opinion, in a way that justifies the fundamental setup here or the movement of the commodity. So this first chart that I had brought up, this is a chart I like to watch pretty frequently. So this is essentially URNM, which is, for better or for worse, a basket of uranium miners. And this is a relative chart comparing it to the spot price of uranium. So what we're looking at now is we went on this big run at the very beginning of the bull market. So the beginning of the bull market was December of last year. December of 2020, excuse me. That's when the equities really took off and started to drastically outperform the physical commodity. In fact, they moved before the commodity did at the time. Now the commodity's caught up. We've found ourselves in this year to date so far of generally a risk-off environment across markets, and uranium has been no exception to that. It's performed better than the broad market, but look at the valuations of the miners relative to the commodity itself. I mean, we did actually retest the levels prior to the taking off of this sector at the beginning of the bull market, and that was back in July, and we were getting very, very aggressively bullish and communicating that to our members back in July. And so now we've got this other risk off moment, and we've kind of been expecting this, over the past couple of weeks, I would say, or maybe up to a month or so, is we've got this incredible setup. We have what is typically a very strong season for uranium, which is the Q4, Q1 season, due to a number of conferences, due to the fact that utilities come back to the table to procure uranium. And there's a unique setup this year because of a bifurcated market with Russia, where we feel that very strongly we're going to have a significant seasonal move for uranium, and the equities. But of course, we've got this backdrop of a weak S&P, rising rates, a lot of fear in the markets. And when that happens, we tend to couple with the market when the spot price isn't moving up aggressively and when we have steep downdrafts in the S&P. Sometimes we couple to the dollar, sometimes we couple to oil when the sector isn't moving on its own catalysts or the commodity on the rise. So if you chart, let's say URA, which is the largest ETF in the space relative to the S&P 500, we are in a long-term outperformance of this since the beginning of the bull market. But if you really zoom out, we've barely started this run of the rotation of money, let's say, and the general outperformance of the uranium equities to the spot price, to the S&P, excuse me. This green arrow was me basically making a statement that I didn't really care where the broad market went, and generally speaking, I kind of don't. I mean, I'm cautious going on right now, but I'm also getting more aggressive because I think that whatever pullback we tend to see in the next, let's say, few weeks to potentially few months, in my opinion, that's an unbelievable gift to anybody that's still positioning in this sector. But you have to understand the fundamentals because it's so volatile and it absolutely shakes people out left, right, and center. So that's just kind of a really broad picture of where we're at currently with this thesis. In my opinion, we got this big reset this summer with markets going risk off. I mean, we literally reset to the beginning of the bull market. So if you had asked me last fall, you'd asked me October, November of last year, after SPUT came on the scene and started buying a lot of, the Sprott Physical Uranium Trust started buying a lot of uranium. The uranium price went on a run. The equities went nuts for about 3 months. I would have said maybe we're in the third or fourth inning at that time. And now we've pulled back a lot. That's a baseball reference, by the way. Now I'd say we're back into the second inning again because of this reset that we've gotten from these, from the risk off markets that we've been in this year. So that kind of brings us up to speed to the center, and I can to the present, and I'm happy to expand on any or all of that. And I think that there's a lot to be said about the bifurcated market because of what's going on in Ukraine. But anything you want me to expand on in particular, Alex?
Yeah, I think if one is new to the sector, a question I think a lot of people have is is it playable with ETFs and investment trusts, or do you have to get into the weeds? Because when you dive really deep into some of the stock picks in your service, there are some pretty sizable companies, and there are some micro caps that aren't available on every brokerage. Um, often in trade in different currencies and so on, and it can get pretty complex. So, how would you differentiate between someone who's completely new to the sector, wants to start in a relatively low risk way, and then as they get more comfortable, how they would drill down and get more direct exposure? What would you use on that? And again, just to be clear, I'm not asking Justin for any investment advice. This is just overall commentary on how to play the uranium sector.
Well, I actually think the safest bet within, again, big disclaimer, it's an extremely volatile sector, but the safest bet, in my opinion, is the Sprott Physical Uranium Trust, because you're essentially trading the commodity itself. So when you understand the fundamental setup, when you feel like you have a grasp of the fuel cycle and you feel like, okay, I'm convinced uranium is going higher, what's the safest way to play it? The safest way is probably to trade the commodity itself. So besides actually owning a can of yellow cake that's being stored at a converter and paying that fee, you can buy trust units in the Sprott Physical Uranium Trust. They do have a US OTC listing, but generally speaking, we recommend that people buy it on the TSX for liquidity reasons and a smaller bid-ask spread. But you can buy it in Canadian dollars or US dollars. It tends to trade relatively close to its net asset value, although when the markets go risk off, it drops to a significant discount. So when we dipped back in July, we had reached on this lowest day, actually back in July, it had gotten, I think, to a 16 or 17% discount to NAV. So basically that's, the value of the uranium they hold is their NAV. And when the trust trades down, when the markets go risk off, you can essentially buy uranium at a 17% discount to what it trades in the market, in the actual, nuclear fuels market.
Hey, Justin, I have a dumb question for you. We were talking about investment trusts in our chat room today. Who validates the NAV for the Sprott Trust? So obviously they self-publish their NAV, but is there some way of checking that the NAV is broadly correct? So when you are measuring the discount or the premium to NAV, can you count on that?
I mean, that measurement typically will come from reporting by Sprott at the end of every single day. So
Yeah, okay.
I don't know who checks it, but I know that Sprott is very transparent with all the data points around the trust. So every day they will update. It's around 4 p.m. my time, which is Pacific Standard Time. So it's probably early morning over there.
And for anyone who doesn't know Sprott, they're a commodities asset manager. They have gold trusts, a bunch of other physical trusts. So as far as I'm aware, they've never hit any problems with NAV reporting issues across their funds, have they?
Not that I'm aware of. No, I mean they're a pretty reputable.
They can be trusted, basically.
Yeah, I think so. I mean, you can also do your own calculation as well based on the current value that's being reported for, or the current price of the spot price of uranium that's being reported by Numerico, for example. You can follow them on Twitter, and then you can multiply that by the pounds they hold in the trust and compare it to their trust units outstanding in the existing price, and kind of come up with your own rough ballpark of NAV. But like I said, they post it every day. They post how many trust units they issued, how much money they raised, how much uranium they purchased, and the actual premium or discount to NAV on their website. So they brought a lot of transparency to this market that generally is very opaque and difficult to follow and understand. So they've been really kind of a godsend. They've cleaned up a lot of uranium. They've purchased almost 40 million pounds of uranium in 13 months. So it's a pretty phenomenal trust here. So yeah, with this particular vehicle, I would say that this has the most attractive risk-adjusted reward profile. So the downside risk for the actual physical commodity here, in my opinion, is very, very little. I don't, we're sitting right at like $49 a pound, something in that ballpark right now on the spot price. I would be very, very surprised if that ever drops below. Well, if it drops below $40 anytime soon, maybe after a big correction after the bull market, but even then, I still don't think we're going back to those levels, probably ever. I would be very surprised. So what is that? We're talking 20% downside, and the upside, I think, is 100% plus. And that gets into price targets, and I don't really like to do price targets for something that's so potentially manipulatable by financial interests. If they get aggressive and start piling money into the trust and they buy uranium in a thin market, the price movements could go far beyond what the nuclear industry, let's say, needs in order to incentivize projects on the margin to bring supply online, right? So, we're talking about, the marginal project. So Bannerman's Etango project in Namibia, it's a huge, huge asset, and they've got, multiple hundreds of millions of pounds proven out, but it's low grades. And, their latest DFS that they did, or this might have been a PEA, excuse me, that, this was still prior to inflation and labor markets being somewhat problematic, et cetera. They were still needing, $75+ a pound, not to mention long-term contracts and a lot of capital raised to make it happen. So that they're likely now more into the $90 to $100 a pound range for the marginal production. The marginal production has to come online to fill the supply deficit in the later part of this decade, and that's why that number is important. So you can make a pretty strong bet that we need to see the uranium price double. And I'm not the only analyst in the space that believes that. Is it a guarantee? Of course not. Nothing's guaranteed. But if the sector just plays out, let's just remove the financial interest for this particular mental exercise and just say, okay, we have this huge supply deficit. We need these mines to come online by the end of the decade in order to balance the market. What price do they need? Okay, they need $90 to $100 a pound. Well, that's where the price needs to go, and that's a double from here. So risk-adjusted reward, we like the Sprott Physical Uranium Trust a lot here. After that, then you're looking at the ETFs because you spread the risk out. You buy just a big basket of miners. URA is probably the less risky, but it's going to be less rewarding. It's only 70% invested in the uranium space. It has 30% basket of various mining stocks and stocks that are related to these spaces. But URNM is 100% invested in uranium. So URNM definitely has more leverage. It's outperformed URA since the bull market took off. URA has better liquidity. URA has a better options market. The options market is just not that deep with URNM.
Yeah. We'll cover some charts on these later. As I mentioned earlier, in our work, we do technical coverage of U.UN, which is the Sprott Trust, URNM, URA, a couple of the others. And the angle we take is we accept the fundamental argument completely. As the sector has financialized, because it's such an emotive sector, trades beautifully to Elliott wave and Fibonacci analysis, pitch perfect so far. And so I will comment on price targets in a way that's unrelated to what the nuclear industry needs. The price targets that you can look at are pretty dramatic. It's very volatile, and so using some sort of risk management, be it stop losses, trailing stops, hedges, whatever you like to use, is a good idea. But the upside in some of these things is pretty remarkable, and I'll walk through some slides after Justin's finished, just to give you an illustration of what that can look like. Hey, Justin, we have a couple of questions coming through on the Q&A panel. One from Sandy, which is quick question: for long-term investments, do you look at 1 month, 2 months, 6 month, or year chart trends when you do the technical analysis?
For long term, I tend to look at weekly charts and zoom out at least to where the bull market began, if not backing up a little bit more than that. So, and I really like to look at relative charts as well. I think that I was showing you URNM relative to the commodity, but if URNM just basically launched in December of 2019, so you can't really zoom out that much. But URA relative to the spot price of uranium on a weekly chart, you can really kind of zoom out and get a better picture of really where we are. I mean, this doesn't even look like a bull market, right? If you look at the basket of miners and URA relative to the commodity itself, we're just really not there. Looking at the commodity itself, charting that, like Alex mentions, he's probably looking at some pretty phenomenal price targets based on Elliott wave, and you can see this big spike in the previous at the end of the previous bull market, and that was almost entirely financial driven, right? Because you had utilities paying 80s, 90s. Some utilities did pay over $100 a pound back in 2006, 2007. They never lived it down. But what you did have was you had hedge funds buying physical uranium and just continuing to push the price up. And in my opinion, that is absolutely going to happen again. But for the most part, I mean, to answer her question or his question, I apologize. If it was a he or her, I don't really know. I think you said Sandy.
I
Could
did.
be.
Sandeep.
Okay, sounds good. Yeah. Oh, Sandeep, sorry. This, I primarily focus on the fundamentals because a lot of times what happens is when the charts are looking their worst has been the best time for me to buy. And so if I look at Cameco, for example, and we go back to just this past summer where the chart was pretty much kind of breaking down from that run. We had a really good run from the bottom in late January, and that was the URA rebalance. So we had risk come off. There was fighting in Kazakhstan. There was civil unrest in Kazakhstan, which is the largest uranium producer in the world. And markets were just going risk off at the time. And then we ran on a really strong run into April. That pulled back pretty violently towards the end of April, but fully came back down to this trend line. And so I tend mostly to look at volume and moving averages. I don't put a whole lot of faith in trend lines, although I find them interesting. And then, of course, I look at patterns and RSI mainly on daily charts to look for intra-trend chart patterns for reversals in both directions. So for example, still looking at Cameco, this looked to me like a pretty clear rising wedge that I predicted we'd fall from, and we absolutely did. Got a little bit of area of congestion here from back in August. We could see some support right near that 50-day. I have a feeling we might lose that if markets stay risk off. Then we go back and look at this long-term trend line. So I guess that's kind of a long answer to say I put most of my faith in this market and fundamentals, and I tend to watch charts just to kind of see where we are in that run in terms of areas to either add conviction and buy when things are weak, or potentially trim or at least not buy and chase when things are a little bit overbought.
Yeah. We have another question from Michael. Thoughts on UUUU, that's energy fuels, I think.
I mean, they're one of the only companies that are actually physically producing anything in the United States through their Smith Ranch ISR project. They still do not have White Mesa operating. They'll probably get that operational, I think, maybe next year or the year after that, if we continue to see the bull market run. They dilute a lot. They through an ATM. They've sort of diluted their focus into rare earths.
Just for anyone that's not familiar, just an ATM, that's an at-the-market facility. Could you just walk people through that?
Yeah, so the company can essentially at will issue shares into the open market to raise cash. Right. And so what that does is it gives the company a lot more freedom to raise cash when they need it, which is obviously a good thing for the company. But if it happens often and the companies raise a lot of cash and issue a lot of shares, the value of your shares are essentially worth less. So not only are worth less, not worthless, but they're worth less because the total number of outstanding shares continues to increase. And this really, I mean, I don't not necessarily via the ATM, but the Australian equities tend to have extremely high share counts. So when you're in a bull market, it doesn't matter quite as much when there's a lot of buying pressure on the stock. But if there's a lot of dilution when the stock's going sideways or falling, it can definitely kind of be a hindrance. With all of that said, they have an okay options market. There's pretty good liquidity in energy fuels, and they have very good name recognition. I'm sure it's going to do fine in this bull market.
Great, thank you.
Sure.
If I may, as this is a good time to do it, I'm going to jump in and just walk folks through how we view a couple of these stocks. We look at a different lens. We use the Elliott wave and Fibonacci tools, which are not particularly better than the ones you've seen. It's just a different method.
Yeah, great.
So I'm just going to walk through a couple of charts because I'd like folks to see, what the potential could be. Now, again, this is a volatile, risky space. And there's no easy money in this world, as everybody knows, and this certainly isn't easy money. But I do want people to see the potential that we see and that we talk about in our services. So I'm just going to make myself presenter again. Hold on. Okay, just 1 second. Okay, so this is the Sprott Trust that Justin's been talking about. So in our work, we treat this as, just any security. Okay, so our start point is fundamentals are good for all the reasons that Justin's explained. And we've covered this for 12, 18 months, I think. I'm going to talk about URNM in a moment as well, but this is the Sprott Trust. So if you can follow this bottom left of the screen here, that's the COVID lows. And for those who are familiar with the Elliott wave system, this will be obvious, but I'll walk you through it. The notion of Elliott waves is that things move up in sets of 5 waves. So 1 up, 2 down, 3 up, 4 down, 5 up. And then they correct usually in 3 waves, A, B, C down. And this all looks very complicated and scientific. It isn't. It's just trying to find a way to measure emotion, for want of a better word. The measurements in Elliott wave aren't necessarily dollars per share or even timeframes, but it responds really well to using the Fibonacci sequence of numbers to look at the movements up, which is called an extension, and down, called a retracement. And we can talk about that for 14 years, but we find this pretty good in our work. And the more emotive the stock, the better the system works. The more liquid the stock, the better the system works as well. So this is the Sprott Trust. So this is the COVID lows down here, March 20 the low, puts in a wave 1 up from $6 to just over 10, and then a wave 2 retracement down to the end of October. Now, you can see down here that this wave 2 finishes at what's called a 61.8% retrace of wave 1, which just means it drops down 62% of what it moved up. And why that's relevant is that's a defining characteristic of a wave 2. Okay, so we have a 1 up and a 2 down that bottoms exactly where a 2 should bottom. So you can be pretty confident that's a 2. Why that matters is because a wave 3 is, when you find one, a really powerful, strong move up. And if you can find a way to buy stocks at these wave 2 lows, then you can have 2 things. 1, plenty of upside, but 2, actually a really sensible place to give yourself some downside protection, be it through a stop or a hedge, or whatever it might be, because wave 2 lows tend to put in, a low for a very long time. So the Sprott Trust moved up from about $8 a share up to a peak of 18. So it more than doubled in only October 2020 to September 21. So in less than a year, it doubled. That's the kind of volatility that you're dealing with here. That's good on the way up, bad on the way down, and unless you're using proper risk management techniques. Again, you need to be aware. From this wave 3 high, it put in a wave 4 correction down here, and then a final wave 5 up, peaking around 20 from memory, $20 a share in April this year. It then sold off pretty hard. As Justin said, this has responded really to 2 things, I think. 1, the general risk-off appetite in the market, that's certainly affected it. And 2, it's not a great look when people are throwing bombs at nuclear power stations on the television. And so far, nothing bad's happened, but it doesn't help sentiment when that happens. Now, you can't quite see this here, but this has put in a characteristic A, B, C correction. So it moves down, up, down. And that, again, that's a defining characteristic of a move down. And why that's important is because the way the system works is we have 5 waves up, that forms a single larger degree wave 1, okay? And bear with me here. Why that's important is because what comes next is a larger degree wave 2. And as we just said, when you hit a wave 2 low, be it in the smaller degree or the larger degree, that can be a persistent low. That means it can mark a low for a very long time. And so buying anywhere in this area can be, for stocks like this, a really productive thing to do. Because again, you can place stops or hedges or whatever you want to call them, whatever you want to use down here, not too far away from your purchase, but you can have a ton of upside. Now, in our work, we use the so-called wick-off cycle for these longer-term investments. And the notion here is that institutions will tend to accumulate stocks down at these lows. They'll buy slowly, a little bit every day. They won't YOLO it. If the stock runs up too much, they might take some profits and buy when it's down here, but they'll accumulate slowly. And then this typically happens when the market has cooled on a stock, or the market has cooled in general. And so when a narrative subsides somewhat, when nuclear isn't, the hot button, that's when you'll find institutions accumulating this kind of thing. And then once institutions have accumulated any stock, what you can see is a so-called markup cycle. And at this point, you'll see a ton of stuff all over the TV, all over the internet about the topic in question. Now here, this is uranium, but this method works for most all stocks. So we would expect to see increasing focus on nuclear. It's already happened with the energy crisis across Europe and to a lesser extent in the US. But as that chatter, that narrative ramps, we would expect to see these names move up. And it's called the markup zone because if you've done your work properly and you've bought in this accumulation zone, you don't need to do anything. If you finish buying below this 38.2% retrace of that wave one up, then let talking heads on television mark up the stock in your account. Let people come to the sector relatively late and mark up the stock in your account, and that's free money. Now, if that's right, this is a wave 2 low here. We're in a large degree wave 3 now, and it's already started. And if that's true, well, standard wave 3 extensions run something like this. And again, if this is new to you, this isn't complete voodoo. It is a reasonably reliable, nothing's perfect, but it's a reasonably reliable system. And a wave 3 will take you to 3 different levels very commonly. First of all, it should take you above the previous wave 1 high. So this is your larger degree wave 1 high at 20 here. So we've set a chicken bull target here is $20. So really that should be 21, 22 minimum target if this is a wave 3. A very common place for a wave 3 to end is what's called the 100% extension of the wave 1. That sounds fancy, but it isn't. It just means you take the share price change in the wave 1, so that's from 6 to 20, so $14 a share. You multiply it in this case by 100%, 1, and then you add that to the bottom of the wave 2 low. So you take $14 a share and you add it to, what's that, about 12. So you get to a reasonable bull target instead of 26. And that's a big multiple up from here, but that's not technically silly at all. And then we've called this up here a crazy rodeo bull target, but it's not really. Wave 3s very often end at the 1.618 extension of wave 1. So if you look at the S&P, the NASDAQ, they do this sort of move all the time. And this is a much more volatile stock than those indices. And so there's every chance it can do this. 1.618 extension, just the same before, you take the share price movement in wave 1, so it's $14 a share, multiply it by 1.618, add it to the share price at the wave 2 low, gets you to around $35. So this isn't to say that any of these things will happen. What this is to say is when you have a very volatile instrument like this that has underlying solid fundamentals, this method works really well. So try and accumulate around these wave 2 lows here, use risk management, whatever suits you, below that to protect yourself. But then if this is correct and you do see things all over the news, if you do see nuclear power stations all over the news, if you do see clean energy gurus start to talk up nuclear, as surely they will soon, there's every chance this can happen. That's Uranium Trust. I talked briefly about URNM as well, so I'm going to switch to that. And just to show you something really interesting. Okay. We won't go through the price movement so much. What I want you to see is the volume profile by price. That's these dark blue bars on the side here. Now, I said earlier, it's not often you get to invest in a sector that's really early in its financialization. And if you think back to what Justin was saying, which was that in 2016, he started to get into this, even all the way through 2020, the volumes traded in URNM, and it was a relatively new ETF, but the volumes traded tiny, absolutely tiny. And they only start to get material up here from around March 21 onwards. And you're now starting to see a good degree of volume traded here at these prices. And so, again, we call this the accumulation zone here because you can see institutional buying. This is not retail, this is institutional level volumes. And if true, Again, we would expect this ETF to start to take off. And just to very, very briefly draw in how we think that might work, you've got this 1, 2, 3, 4, 5 up here you see in white. That makes for a larger degree wave 1, like so. We've been in a larger degree wave 2 just now. And if you were to measure the retrace here, you'll see that, yeah, so the wave 2 bottom below the 0.5 and the above the 618 retrace, that's about right for a wave 2. And if correct, then this fund is now in a wave 3 up, which, as we've seen in wave 3s, we won't go through the price target, but can be a lot higher. And this is sort of confirmed by this volume of buying here. So what you're seeing here is institutional accumulation, and institutions, can and often, can be wrong, often are wrong, but very often they're not. Very often they move enough money to create opportunities by themselves. So this sector, it seems to us, has gone from, a curio when Justin, rather brilliantly picked it up, to a sector with promise, to something that has got real institutional heft behind it, or starting to have now. And that sort of pressure of buying is also what interests us about the sector. So I'm not going to go over any more charts, but in addition to all the fundamental arguments you've heard, the chart logic here, the purely technical chart logic, works pretty well. I'm going to hand back to Justin just now.
Yeah, I love that. Thank you for sharing that, Alex. That's it's exciting for me to see someone else's analysis there and put that against my own conviction on the fundamental side.
Yeah, we can bore you with that literally all day and night and the next day and the day after that.
Yeah, no, it's really great to see. I have similar, I've had similar conversations with the he goes by North Star Charts on Twitter, where we had a chat about, I brought the fundamental side, he brought the technical side, and it was very kind of similar. So that was I like to see that bolsters my excitement, because my excitement is really based on numbers, and obviously a lot of these other developments, like seeing this kind of quote unquote nuclear renaissance happening, is just kind of fuel for the fire for me. But really what it comes down to is where I expect this market to go in terms of price for the commodity, and then just kind of a trust that the equities will follow suit as they typically do.
Right.
I do think we'll see some risk come back on the markets at some point not too far in the future, and even without that, we are generally outperforming the broad markets as it is. So once we see a movement in the commodity that we expect, that's really where things get exciting. And so I think one last point I think would be important for me to drill down on, if you're okay with it, is kind of what's going on, like a really, really quick run through the fuel cycle, and then what's happening with the bifurcated market. Does that sound okay?
Yeah, that would be great. And then to finish off, I'm going to talk about how people can get access to your service, and we'll share a link and a discount code and so on.
Sounds good. So the reactors that are operating in the world can only operate on uranium. Now, some of the reactors in France and Japan, they use what's called MOX fuel, which is mixed oxide. It's essentially recycled nuclear fuel, but that's sort of an anomaly, not really baked into the calculations all that much. Reactors can't just run on mined uranium. So the uranium ore is mined out of the ground through various means. That would be open pit mining, underground mining, which typically deals with much higher grades, like in Canada, or ISR mining, which is in situ recovery. It's basically injection and recovery wells that extract uranium mineralization from an aquifer, and that's how the Kazakhs do it. That's how most of the mining in the US is ISR mining. The Uzbeks are ISR mining, and that is the most efficient means of mining. So if you have the right geology and even reasonably low but decent grades, you can extract a lot of uranium. So the Kazakhs produce about 40% of global production right now currently. That's almost 60 million pounds a year in total. And Kazatomprom is a company that produces all that uranium. And they have a bunch of JVs, so the company itself is about half that production. And half of the production out of Kazakhstan basically goes to China. with all of that said, okay, so you have the mined mineral, but that's just one part of the process. You know, you have the reactors run on fabricated fuel rods that are made precisely for that individual reactor. And this process of turning the mined uranium into fabricated fuel is known as the nuclear fuel cycle. And that process essentially is you have the mined mineral that's turned into yellow cake, which is uranium oxide, or triuranium octoxide, U3O8. And there's a mild chemical process that creates that. That's the yellow, you know, the literal, like the yellow dust that you see that's stored in a can in a drum and shipped around the world. That's the yellow cake. That's basically what most of the investment vehicles in this space are, miners that produce that. But that's just the first stage. So that material has to be enriched because the actual isotope that's fissile within that uranium is too low in order to create a strong enough reaction in a reactor core and produce enough heat to boil water essentially and you know, spin a turbine. So this material has to be enriched. That isotope has to be enriched. But in order to enrich it, it has to be converted from that yellow cake into a gas form. So it goes through this fluorinating process where it's turned into uranium hexafluoride, UF6, and that goes to the enricher. Then that material goes into a centrifuge where it's spun at very, very high speeds because the different isotopes within that UF6 are very, very slightly different in mass, and that spinning will separate those isotopes. And so that fissile isotope, the U235 isotope, is only 0.7% of the total, and that needs to get enriched up to about 4.5% of U235 in enriched uranium. That enriched uranium then gets deconverted back into a solid, and then it gets made into fuel pellets, and those fuel pellets are fabricated into fuel rods. And this whole process takes about 18 to 24 months from the mined material out of the ground into fabricated fuel. Now, it's important to understand at least that brief overview in order to understand some of the bearish arguments, which are there's plenty of uranium in the world, the price is never going to go up. Well, first of all, the price has tripled in the past 6 years, so there's no sufficient excess of supply to keep the price down at this point. Price of commodities do not rise in a supply glut. But second of all, there's uranium everywhere. It's one of the most abundant elements in the Earth's crust. There's uranium in your backyard. There's uranium in my backyard. There's uranium in groundwater. There's uranium in seawater. It's everywhere. And so, but it's not everywhere in high enough grades where the current price in the market can justify extracting it, let alone jurisdictional approval to mine a fissile material out of the ground. The other element that's important to understand with this fuel cycle is that the services of the fuel cycle, so that's the conversion, the enrichment, the fuel fabrication, while the mines are, I mean, the biggest player is Kazakhstan, right? 40% of global production, but you still have mines in various parts of the world, in the United States, Canada, Kazakhstan, Uzbekistan, Namibia, Niger, and Australia. Those are really the prime, and there's a couple of other smaller ones, but those are the main ones. So you have a decent amount of diversification in the mining with an exception of a pretty big concentration in Kazakhstan. With the services of conversion and enrichment, Russia happens to be the largest player in both of those services. So Russia is about a high 30s percentile player in the conversion market, and about 40% of global enrichment capacity is in Russia. So what's happened this year with Russia's invasion of Ukraine is the Western utilities, the Western nuclear utilities, which make up 70% of global nuclear capacity. So 70% of, let's call it the market for uranium and nuclear fuel services is in the quote unquote West. The Western utilities are not signing new contracts for conversion and enrichment with Russia. So what that has meant is the Western providers of conversion and enrichment have seen a big influx of business, and that has spiked the price up in both conversion and enrichment. We have a conversion facility in the United States coming online next year that was on care and maintenance. That's Converdyne's Metropolis facility in the state of Illinois. There's a shuttered conversion facility in the UK called Springfields that potentially could come back online. We're kind of hearing whispers about that, but it's unconfirmed. So conversion capacity is strained, but barely sufficient right now. So technically, that's the biggest bottleneck, but there's sufficient capacity at the moment to bring mined uranium through the fuel cycle for the demand in the West, let's say, to come from supply of conversion in the West. Let's move to enrichment. This is the big key. And I'll share my screen in a second because I want to show something to justify the numbers that we're seeing. Enrichment takes a long time. Well, conversion does as well, but enrichment takes a long time to produce extra capacity of enrichment, right? So actually to build out more centrifuges and add those to your enrichment cascades and build out more actual capacity to convert to enrich. We're talking multiple years and multiple billions of dollars. The only way that the enrichers in the West can meet the current and future demand in the West in this market that is now basically officially bifurcated. I mean, the Western utilities are still receiving deliveries of enrichment from Russia, but even that is walking a razor's edge. They don't believe that that's going to continue for very much longer, and they're definitely not signing any new contracts with Russia. So the enrichers, what they can do to meet that new rising demand, because the Western enrichment capacity is only about 40% of the total global enrichment capacity with 70% of the demand. You can see the problem, right? So what the enrichers can do is they can do something that's referred to as overfeeding. So they can actually raise the tails assay, which is the amount of the fissile isotope that's left over in the quote unquote waste product of that enrichment process. So the more of the good stuff, let's say, that remains at the end of that process, the faster they can get the feedstock, the UF6, through that process into enriched uranium product. Also, the higher that tails assay, or the more U-235 that's left over in the tails, the more feed they need to put into the centrifuges in the front end, right? Because they're spinning the stuff faster, or the material is moving through that process faster, okay? So that's known as underfeeding. The opposite is true in the recent past. If they had extra enrichment capacity, which they did, they could actually spin that material down to a lower tails assay and utilize less of the feedstock than they were provided by the utility. So when a utility signs a contract for enrichment, they have to provide the feedstock based on this calculation. Let me, is it okay if I share my screen really quick?
Yeah, you're set up, Justin. Just hit it now.
Can you see that now?
Yeah.
Okay. So Urenco is one of the enrichers in the West. They have a facility in the United States and they have facilities in the EU. So what we're looking at right now is called a SWU calculator. Now SWU stands for separate of work unit. It's basically just the cost of enrichment, and the amount of SWU essentially means how much energy is going to be needed to produce what you're looking for. Okay, in terms of I need X amount of EUP at this product assay, which is, can you see my mouse on the screen share?
Yeah.
Okay, cool. So the product assay, 4.4%, that's the actual enriched uranium that the utility needs. We're gonna go down here, calculate feed and EUP from SWU quantity. Okay, so this is really, really interesting. SWU quantity, SWU capacity in the West, so the amount of enrichment capacity that exists in the West is 25.7 million. Okay, 25.7 million SWU in the West. Now, the tails assay that Urenco was operating at 12 to 18 months ago, 0.18. Okay, ish. 0.17, 0.18, 0.19. Let's do 0.18 for this particular exercise. Feed assay. This is the natural uranium, UF6, 0.711% U-235. It's going to be enriched up to 4.4% U-235. And the tails assay is the amount of the U-235 that's left over in the tails, right? And so when they sign these contracts, they say, okay, how much EUP do you need? What is the product assay? Okay, and the utility will say, okay, I need this many kGU of EUP at 4.4. Urenco says, okay, we'll do that at 0.18 tails assay. Boom, feed quantity. Then you take this number, 26020881, 26 million KGU at UF6. Okay, and this is not for one utility. This is total Western SWU capacity, right? 25.7 million SWU. Take this, multiply that by 2.601. That kicks out a number of 67, let's just call it 68 million pounds of U3O8, and that's the conversion U3O8 to UF6. I know this is getting geeky in the math, but it's important to understand why we're so confident in what's about to happen, okay? Now, we already know that Urenco is operating at 0.24 to 0.25 tails assay. They've already jumped up that much, okay? So if we were to take this same calculation and say, let's say this year, or let's say even next year, Urenco and Orano, which is the other main enricher in the West, they're going to be operating at 0.24 tails assay. And then we'll take the full capacity of the West, 25.7 million SWU, 0.24 tails assay, calculate that. Then we got 333, 55, 238, 33.3 million KGU in UF6 times 2.601, 87 million. So this is in the West alone, okay? So we're talking about a 19 million pound increase in feed demand simply by this jump in the tails assay by the enrichers in the West. And this is only in the West, okay? To add to this, we already know also that these Western enrichers are signing contracts out into the future at a much higher tails assay. We're talking 0.28, 0.29, 0.3. That gets into even more stupid numbers. So what this means is, although you can calculate the total demand of U3O8 based on actual burn rate of reactors that are operating, the fact that the tails assays have risen this much, this equals a legitimate 19, 20 million pound demand increase right now. So this is really, really big. Now, the underfeeding part of enrichment is extra capacity. In the past, they would operate at a lower tails assay than the contracts they had signed. They would have extra UF6, which is the feed, and they would sell that into the spot market. That's underfeeding. Underfeeding and re-enrichment of tails, also done with extra capacity. We're talking 25 million pounds a year that happened globally. Now, if the Western enrichers are 40% of that, that's 10 million pounds in underfeeding and tails re-enrichment, at least. That's gone, okay? So not only are we seeing a 20 million pound swing from this jump from 0.18 to 0.24 tails assay in demand, increase in demand, not swing, we're seeing 10 million pounds of underfeeding gone, and now it was secondary supply. That alone is a 30 million pound swing in this supply demand dynamic. So to sum all of this up, basically what we're talking about is a market that's already in a severe structural supply deficit. Structural, I'm talking about mined supply compared to actual demand from reactors. Talking about 40 million pounds this year. You're adding to that a 30 million pound swing due to tails assays rising and underfeeding in the West essentially not happening any longer at this tails assay and this level of demand, on top of the financial players on the buy side. So that's SPUT purchasing 17 million pounds a year. The deficit has just essentially doubled because of this bifurcating market, and that is going to stick. I believe that is going to stick. I don't know about the super long term. I don't think Putin's about to give up. I don't think if we have peace, if the war is over tomorrow, I can't see the West just saying, okay, all is forgiven, let's keep doing business with Russia. I really have a hard time believing that's going to happen. So going forward, we're looking at a bifurcated market likely for the coming years of this bull market. So this has really basically just taken the whole thesis with the supply demand dynamics that were already bullish and add an exponent to it. To wrap this all up, utilities this year, because of this bifurcation, have been rapidly securing contracts for conversion and enrichment in the West. And what happens is you sign the enrichment contract based on the numbers that I just shared on that SWU calculator. That tells the utility how much uranium they need to buy. So what utilities do is they buy their enrichment contracts. They secure their conversion contracts and then they go buy the uranium. Well, guess what? They haven't done that part yet. They're drawing down inventories and they're signing service contracts for conversion and enrichment. The U3O8 buying to feed those contracts has yet to happen en masse, and it is going to happen. And so that's what has me so excited, even for the short term, because we're coming up on what's typically a strong season for uranium. I think the demand for uranium, from what I just discussed, is going to hit within months, and I think it's going to continue at these levels until we have new capacity in the West for enrichment. And that's going to be years away. So I really think this thing has legs, and the numbers that we're seeing are pretty astronomical in terms of the supply demand disjunct here. The setup couldn't be more bullish for this commodity right now.
Justin, that's a great way to finish. Thank you so much for coming to talk to us all. Folks, as you can tell, Justin's level of experience and expertise and the in-depth analysis is truly fantastic. And one thing I can't recommend highly enough is that you subscribe to his service. It's called Uranium Insider Pro. After this webinar, everyone will get an email with a link that you can use to sign up. If you use that link, it's a Cestrian link. We have an affiliate relationship with Justin's company. What that means is if you sign up via our link, we get a commission. We'll share some of that commission with you such that you get a 20% discount on your subscription, whether that's an annual or a quarterly subscription. So you'll get 20%, what used to be called a mail-in rebate for anyone old on here. So as soon as you've signed up, we'll wire that to you via your PayPal account or whatever you like. The subscription cost is $597 a year, Justin, I think, for the annual before a rebate.
$597 for the year, $197 for the quarterly.
Yeah, and you know, there's 1,000 security services around there. We as a company don't subscribe to very many at all, a handful. And this has been one of our way better decisions to be a subscriber to the service over the last couple of years. So again, I can't recommend it highly enough. That doesn't mean you're guaranteed to make money. It doesn't mean that uranium is definitely a great investment. It doesn't mean any of those things. What it does mean is it's a superb publication where you get printed notes sent to you, regular webinars, and just, as you can tell, a very, very, very knowledgeable company at the heart of it. So that's all we had today. Thanks everyone for attending. Thanks again to Justin for coming to talk to us all. Hope everyone's learned something and enjoyed it. And after this, everyone will get an email with those sign-up links if you are interested. And again, thanks to everyone for being here. Appreciate it.